the way I think about inflation is basically the place where you're going to basically equate demand, supply and demand. So I look at demand at the moment, and I see only positive. Firstly, obviously, we've got like a monetary policy which is super loose, but of course you will all agree that it didn't work for the past like 30 years to have like loose monetary policy. So why would it work in the future? And really the answer is crystal clear to me, is that monetary policy is only basically supposed to facilitate and to cheapen fiscal policy. So if you've got just like really loose monetary policy and basically nothing at the back, it's basically like just like pushing on the string. You're basically leading to you're creating money base, but there's basically no money velocity, and there's like no animal spirits, and basically money base is just gonna stay where it is. What we've got this time is both sides of the equation, and basically an economy that is both working on monetary and fiscal legs. And for the first time in 30 years, we're actually working on both legs. And we're not only having like a bit of a fiscal push, we're having like 5 trillions in the US, which by the end of the year could easily turn into 10 trillions. And of course, it's not going to be 10 trillions in the next year. It's 10 trillions over the next 10 years, but it's sustainable, like fiscal loosening. So suddenly you just have like a macro policy that makes sense. On one side, very loose monetary policy, and that's facilitating fiscal policy. The reason monetary didn't work before is because it wasn't putting money where it was going to be spent. And this time, that's exactly what fiscal is doing, putting money into the right pockets and basically going direct instead of relying on like trickle down economy, which the Fed has been doing in the past. So, in my opinion, that's really a complete revolution of the macro framework, and a revolution takes a long time to reprice. So in terms of where we are today, we basically have like very strong inflationary pressure, clearly driven by like, obviously like the demand, pent up demand, but also it's not only pent up demand. If you look at all senior loan officer surveys, you actually find that everywhere across the world, whether it's corporates, whether it's consumers, and whether it's for mortgages or whether it's for consumptions, banks really believe that the will to borrow is actually going up quite dramatically. So you've got cheap money, and consumers actually realize that it will not be cheap forever, which is really the difference for the animal spirit. If I tell you that rates are at zero and they're going to be at zero forever, you're not really going to want to borrow, because it's still going to be there next year. So it's really all about greed and fear, and I can see the greed and fear at the moment in the data, and you can say money is cheap and people want to borrow it. So that's one thing on the demand side, and obviously you've got all fiscal. So you've got fiscal demand, monetary policy that is loose, and the willingness to basically chase prices higher. And on the supply side, it's really interesting, but people have been locked in at home for the last basically 12, 18 months, and suddenly everything reopens and we're gonna have fun again, and you're asking people to go back to work. And a lot of like people I'm talking to, they're like, actually they've got high savings and they'd rather just take advantage of the next 3 months and go back to a bit of fun rather than going to like wait in restaurants, and so it's very hard everywhere you look. It's actually really hard to find employees. So I think that's going to be like a short-term story, and eventually like employment will recover fully, and I would say probably into the start of 2022. So you've got some inflation pressures that will dissipate by the end of the year, but I don't think demand is going to go away. So that basically, and to feed that demand, you can see as well that CapEx is really picking up as well. And that's really interesting story, because the macro story of the last 20 years is that corporates were basically egging onto each other, trying to like buy back stocks rather than invest into anything. So you had a chronic deficiency in capital investment, which is, suddenly being solved. And you can see it in the data, like capital investment intentions are like picking up to levels like we haven't seen in many years. So I think we on the back of higher demand and higher capex, we're actually going to step up in growth. I'm not worried about unemployment. I think employment will be sorted, but it will take time, which basically pushes up inflation higher on the supply side until the end of the year. But basically, we emerge into 2022 thanks to pricing power, higher demand, and basically capex into like a macro equilibrium, which is actually superior to what we had in the past 20 years. And in my opinion, that means a higher equilibrium rate. And that means that actually the Fed, while staying at zero, is actually going to get more and more accommodative this year, with basically like a real rate staying where it is, because they're waiting for real progress on the economy. And at the same time, the rising R star means that you're going to get more and more accommodative. And in the end, it's almost the markets that are going to be forcing the Fed to basically hike rates. And that's going to be something that is like a positive for equities rather than a negative. And for me, that's really the trade this year, is to realize that higher interest rates is not a negative on aggregate for equities anymore. And I know it was in the past, but what I'm saying is that it's not going to be the case this year. And that's really going to be the interesting theme that's going to be taking many investors off guard. Now, looking at sectors, obviously, I'm recommending sectors that are much more positively correlated with higher interest rates. But that doesn't mean that I think you should be selling tech. I mean, I was having a discussion with a client yesterday about like Apple and Amazon. I think the real story there is that, are those companies really like growth? I mean, the definition of growth sectors is basically sectors that have like exponential earnings, basically priced so far along the curve that they're basically becoming like long duration assets. But I don't think anyone can say that Apple or Amazon are like the hot and emerging like sectors. I mean, I think they're going to trade much more like mature sectors. So I find it still and cyclicals, but I'm really recommending like cyclicals much more than growth sectors, with the caveat that some of the growth is not really that much growth sector anymore.